Hey, 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 here's the bear, and we are going to study fixed income investing. This is an introduction to class preparation assignment number 5. Yes. And bonds, what are bonds? Well, this entity, could be a government or corporation, issues a bond that has a stated interest rate called the coupon or coupon rate that will be paid at some future point, maturity date, and interest on bonds are usually paid every 6 months. So, just to kind of illustrate that, you as an investor would loan money to a bond issuer, either the U.S. government or perhaps state government or a town or a city, or a foreign government or a foreign company or corporation or a U.S. corporation. That bond pays you interest. Those interests are called coupons or coupon payments, and eventually you're going to get your money back at the maturity date when the bond matures. Bonds matures all over the map, anywhere from one day, you can actually have one overnight loans, all the way up to 30 years, and there are even some 100-year bonds out there called century bonds, which we don't study in this class, very rare. What's this coupon all about? Well, it used to be that if you bought a bond, here's a U.S. Treasury bond, 1898, 3% interest, you would actually get a bond certificate, and attached to that would be a whole bunch of coupons. And what you do is you take those coupons down to the bank every 6 months, and in this case it's every 3 months, and you would actually turn that in at the bank, and the bank would actually pay you interest. Yeah. And that's the same thing for corporate bonds. Here's an old Penn Central Company bond with coupon rates. This is an actual certificate that actually sold at auction. This certificate for quite a bit of money. All right. So who issues bonds? Well, U.S. Treasury, which is basically the federal government, corporations, state governments, such as the state of Kentucky, state of Tennessee, Indiana, local governments. Now that could be a town like Bowling Green, or it could be another entity of a local government like Western Kentucky University, or it could be the Tollway Authority of Florida, for example. Right? They can all issue bonds. Also, foreign countries and their subdivisions. So, for example, in some foreign countries, you have like water system bonds that are issued where the water system is owned by the government. And that's the same here in the U.S. There are all different types of bonds. We're not going to study all of these, right? But as you can see, we are going to study basically corporate bonds and government bonds, and we'll touch on municipal bonds to a small degree, at least for purposes of this class preparation assignment. All right, so what are we going to study? U.S. Treasury bonds, Treasury inflation protected securities, or TIPS, they're called, municipal bonds and corporate bonds. We'll also touch on foreign bonds, both bonds issued by other countries called sovereign debt bonds or sovereign bonds, and corporate bonds issued by corporations that are based overseas. So, where do we buy bonds? Well, actually, you buy most bonds in the market, which means you buy them through a brokerage firm. But you can actually buy U.S. Treasury bonds directly from the U.S. government. In fact, this is a way of doing that without paying any brokerage fees. And I'm just going to pull this up real quick and show you. Here's the Treasury Direct website. Yeah, so let's try to make this a little bit bigger here. Here we go. Okay. Yeah, and as an individual, you can actually set up an account there, and you also get a whole bunch of information, research about bonds and things like that. This one tells you that there's a difference between Treasury bills up to a year in value, Treasury notes up to 10 years, and then Treasury bonds, basically anything over 10 years, but typically issued by the U.S. government in 20 and 30-year maturities. It talks about TIPS here as well. Floating rate notes, which we're not going to study. There's also some other types of inflation-protected bonds, and the old Series EE bonds. Your parents and grandparents may have bought these for you, and you actually might be using them for college on a rare occasion. All right, so we can also figure out how to buy these bonds. So the Treasury has lots of auctions. Almost every week they have an auction, and you can actually go to the auctions, and uh, they offer several different types. So we're going to view upcoming auctions. Here we go. Now, just a couple days ago, this is recorded on August the 8th. So on Thursday, August 6th, they went out and the U.S. Treasury sold $54 billion of 13-week Treasury notes. Treasury, yeah, and then 42 weeks bills, 34 billion. All right, so those bonds were. That's the auction date. Oh, that's the announcement date. So these are actually coming up for auction in a couple days here, and they're actually issued just 2 or 3 days later. All right, and then we have other auctions out here. All right, for other short-term notes, we have an auction that will be done also on August the 11th for 48 billion of 3-year notes. And coming down here to 30-year bonds, we have 26 billion of 30-year bonds being auctioned on August the 13th. So wow, we can actually do that. We can actually see auction results. So for example, here is the auction result. I'm looking for something that's, these are all short-term bills dates. All right, and going back quite a long way here. Here we go. Here's where the bonds were issued. July 31st. The high yield of that auction was 1.059%. So basically, they were paying a little bit more than par value. They were paying 101.17. Now, bonds are priced in $100 increments, but they're issued typically in $1,000 increments. So anytime you talk, what's the price of a $1,000 bond? If it's issued at face value or par value, it's basically issued at $100. You just have to multiply by 10. All right, but they issue 30-year bonds here for interest rate of 1.33%. Now that's the high yield, which means that a whole bunch of basically broker-dealer firms, brokerage firms bid on these bonds. There's about 20 of those investment banks and broker-dealer firms who basically are in this auction marketplace for bonds. You can actually go in and bid, but you don't really bid. What you do is say, I want to buy, for example, $10,000 of bonds or $100,000 of bonds as an individual. You will get whatever the high yield is. So some of these 30-year bonds may have been sold for a yield that was only like 1.31% or even 1.29%, but you're going to get the highest yield. You're going to get the best price that the best of all the firms that auction on them got. So kind of a nice thing there that you don't have to worry about being getting a bad price in the Treasury Direct. Then automatically going to give individuals the best price in any auction. And you don't really have to submit a bid. You just say, this is how much I'm going to buy, and you have that money into your account that you set up here. So we'll close out of that for right now. And continuing on here, all right, and let's see here. All right, maturity date. Yeah, when are you going to get the last payment of interest, the last interest payment, and you're going to get repaid. So if you bought a $10,000 bond, you're going to get that $10,000 back plus the last interest payment that's due. Now, bonds can be classified by maturity: short-term, intermediate, and long-term. So short term, anything less than 4 years; intermediate term, 4 to 10 years; long term, more than 10. However, different people in finance, as you kind of guessed by now, kind of have different views about what short term, intermediate term, and long term is. Sometimes you'll see intermediate term like 3 to 8 years, or 4 to 9 years, or 5 to 10 years, or something like that. So, yeah, us people in finance just can't agree on these things. But this is, for purposes of this course, we'll probably use this, all right? But you may see it a little bit different. It's no big deal, all right? Should you buy long-term bonds or short-term bonds? All right, well, hopefully after we study this class preparation assignment, you'll have an indication of what type of bond you should buy at this point in time, not just long-term or short-term, but also U.S. government or corporation, what type of corporate bonds. Yeah, it's a very important concept when we're talking about buying bonds. It's called duration. All right, duration is this measure of the bond's interest rate risk. It takes into account not only when the money is due, so that's the maturity date. So we might say a bond is going to mature in 20 years. All right, so it has a 20-year maturity. But the duration is going to be less than that because it takes into account all of these interest payments that are paid every 6 months. Okay, so if the maturity of this bond is 5 years and we have interest payments during that 5-year period of time, those cash flows, basically they are weighted. All right, and you can imagine that sometimes some bonds pay more interest than others. So a bond that has the same maturity date, 10 years, if it has more interest payments, it's going to have a lesser duration. And that duration is a lot of different ways of calculating duration. All right, so I'm just going to show you one. Now, if I was calculating duration of a bond, you could do this on a financial calculator. All right, but I am going to show you the easy way of doing this because we like to do things easy in this course. So I'm going to pull up the Money Education duration calculator here. And as always, I'll make this a little bigger so we can see it. All right, here we go. All right, so here we have a bond. Yield to maturity is 5%, coupon rate is 5%. So we'll assume that this bond gets issued at its par value. Okay, it is a 10-year bond. It matures in 10 years. All right, but the duration of this bond is 8.1, or what's called the modified duration is 7 points. The different ways of calculating duration, and typically what we want to look at is modified duration when we see that out there. All right, so a bond is worth $1,000. Okay, and then it shows here what is the estimate change based on the modified duration if interest rates fall by 1%. Then the value of that bond is going to go up by 7.72%. That $1,000 value of the bond today, if interest rates fell to 4%, if a new bond could only be issued at a 4% rate, this 5% bond is more valuable than what you could get a new bond in the marketplace for. So because you're getting a higher interest rate, therefore the value of the bond goes up, in this case from $1,000 to $1,077. Now the actual change in the bond price might be a little different. And the reason is the duration calculation, which is done by a complex formula, basically is not 100% accurate. There's no 100% accurate formula for computing duration. But we can get estimates. If interest rates went up, let's say you bought a bond for 5% interest rate, but then a month later, or if even just a week later, right, the interest rates went up by 1%, then the value of your 10-year bond would fall by 7.72%. That's again the modified duration. Now, we can play around with this a little bit. Remember this modified duration number, 7.72. So that's 7.72 years. All right, just the way that's stated. What if we had a bond that paid higher interest? All right, the duration falls down to 7.36 because we're getting more cash flows earlier than we are getting that repayment of $1,000. What if the bond fell in value down to 3%? All right, and what we find is that the modified new bonds being issued at 3%, the modified duration goes up for this bond, this new bond, because we're getting less interest payments. So let me take this back to 5 and 5. All right, and then say, well, wait a minute. All right, what if our coupon rate stays at 5%? That's the issuing rate, the face rate that we see on the bond, the coupon rate. All right, and what what if what happens if the value of the bond just becomes like 2 years later, right? What we see is the modified duration falls as well. Okay. What if the price of the bond goes uh, up because interest rates go up? Let's say now we have to get a new yield to maturity, and what we see is the modified duration. I'm going to put this back to 10 years. Uh, 7.72 falls to 7.56, so slightly fall. All right. So nice little calculator here for duration, and if you type in duration calculator bond, you'll find a whole bunch of websites that do this. I kind of like this because it gives you a nice little um, bond prices change in uh, estimates. This financial calculator that you have is very nice, but there's a lot of calculators on the web that are kind of easier to use. All right, so let's go back here. All right, just interest rate risk. This is one of the two key risks of bonds. All right. The other risk, by the way, is the risk of default, the risk that the company that issued the bond or the government that issues the bond won't be able to pay the interest payments and the principal at maturity. Yeah. But here, another risk is that when you are holding the bond, that interest rates go up. You could now get the same bond for a higher interest rate. So a corporation could issue, if a corporation or government issued a almost identical bond, same maturity date, but it's going to pay higher interest, that bond is more valuable, which means the bond that you bought earlier is less valuable. As a result, when interest rates go up, bond prices go down, and vice versa. So, what we want to do is when we talk about risk of bonds, we want to talk about lower duration, this lower interest rate risk. And some people think in terms of duration this way. You got a duration of a portfolio of bonds, and the average duration of that bond is 2 years. And if interest rates go up, they go up by 1%, then the value is going to fall by 2%. That's really just a really rough guess. It's not actually that way. And here's kind of a little bit difference here. So change in interest rates that say, hey, interest rates go up 1%. The value of a 1 year bond, a bond that matures 1 year from now, falls by 0.93%. The value of a 20-year bond falls by 11%. 30-year bond fall by 13%. But even this is not accurate because you have to take into account what the interest rate is at the beginning. Is it a 4% bond? Is it a 6% bond? Is it a 2% bond? All of that also affects these. So these tables are not always accurate, and that's why we like to use that financial calculator I showed you. Now, bonds can default, which means it is possible that bonds don't repay their principal. The issuer goes out of business. It files bankruptcy. All right. So bonds are rated by this default risk. All right, and this is called financial strength ratings, and there are 4 or 5 companies that issue financial strength ratings. The long-standing ones are Moody's and Standard and Poor's, and they will issue bonds, and they'll say these are investment grade bonds. The highest quality bonds out there are AAA rated bonds, and then somewhat less than that. They go AAA to AA plus, AA minus. Now, Moody's uses a similar rating system, as we can see. All right, we're not gonna follow Moody's. We'll just follow Standard and Poor's for purposes of our course. But realize that the different rating companies have slightly different ratings in terms of that. And what we see is that you go from A minus, and then you go to BBB plus, BBB, and then BBB minus. And I want to kind of highlight that right there, BB minus, oops, because that is the lowest of the investment grade bonds. And then bonds can become what are called junk bonds, or non-investment grade bonds, or high yield bonds. And that's when the rating falls from BBB minus down to BB plus. So they become more speculative, they're more likely to default. Yeah. So, yeah, it's not all companies have the same financial strength, or even countries for that matter. All right. But so bonds are typically rated A all the way down to CCC or even C. A bond that is rated D is basically in default. All right. So typically you don't see a lot of these bonds out there in the CC and CC. If they're out there, they're basically hardly anybody wants to buy them and the like. All right. So another rating service is actually Fitch. Now Fitch uses the same numbers as Standard & Poor's, and this is just another way of classifying bonds: high grade, upper medium grade, lower medium grade. All right, and then you can classify bonds by long-term and short-term and actually give them different ratings. But we're going to focus on these long-term ratings here. Yeah, and again, anything below BBB minus, once you start to BBB plus, BB plus, and below, that's called a non-investment grade or high yield or a junk bond. Okay. Now, what's the chance of actually these bonds defaulting? Let's say that you were to buy a corporate bond. This is the global corporate average default rate. So these are bonds issued by corporations all over the world. You were to buy a bond from a company that had received the highest financial strength rating, AAA. What is the percentage chance that that bond is going to default in the first year? There's been no bond that defaulted in the next 12 months after a rating was assigned. But 2 years out, 0.03%. And all the way out to 10 years, still less than 1%. So if you were to hold that bond for up to 10 years, your chance of a default in that bond over a 10-year period of time is 0.71. And let's go down to A plus bonds. So we see a default rate. Hey, some of those bonds even default in the first year. And here the default rate ticks up. It's 1.08%. All right. Let's go down to, oops, didn't want to do that. There we go. When we talked about the dividing line, BBB minus is still investment grade, but it's a low investment grade bond. All right, the default rate for those is 5.53%. See how the default rate jumps here as you get into lower ratings? And then below BBB minus are all of the junk or high yield or non-investment grade bonds. And see how the default rate over 10-year jumps from 5.53 to 7.33 to 11.53 to 17%. Yeah. So, yeah, that's putting your money at risk there. When you have a rating assigned like that. Now, bond ratings are assigned typically at the time they are issued, but bond ratings can be upgraded as well. So, if a bond rating fell, if Standard & Poor's went and issued a new bond rating for a company, and that's typically when they issue another bond, but that new rating also applies most of the time to their old bonds as well, unless there's something different about the bond. It might be different, it might be subordinated debt, which we don't explore here, or has some other characteristic that makes it more or less risky. But when new ratings are assigned to bonds, you still have this, you basically go back to the first period of time and go from there. So, let's take come on, everybody's familiar with Tesla. All right, so Tesla issued bonds, and these bonds were issued, I believe, back in 2017, was it? Something like that. Coupon rate 5.3%. So Tesla was borrowing money at 5.3%. All right, and about a year later, after these bonds were issued in 2018, all right, this bond had lost value. So the bond price came down, which means that if you bought this bond, you had a yield to maturity of bond that was higher than that. Kind of illustrate this. This is when the bond was issued here, middle of 2017. Immediately, the price of the bond fell. People were thinking, hey, Tesla may not be able to repay its debts. Yeah, it had negative cash flow at the time, and wow, the price of the bond fell all the way down here to less than $88. Or since it's $1,000 bond, and remember that's less than $880 because you multiply by 10. So that's as of 2018, August 10th of 2018. The bond was trading here somewhere, we'll go back up here, It was trading at $90.75. Let's go forward to, here's the yield chart. So remember, the price goes down. When the price goes down, the yield goes up. Remember that relationship? So if you were to buy this bond and buy it at a cheaper value, your yield, usually yield to call, or something better in this course, we use yield to maturity. The yield to maturity goes up because you're able to buy that bond at a discount. But, and here's kind of some data that we can pull off. Now, this is from the FINRA. FINRA is the broker-dealer organization, and it has a website in which all bonds are listed, all corporate bonds are listed, and you can find information. And what we can do is see that the Moody's rating for this bond was below investment grade, and the Standard & Poor's rating was also really low. It was below investment grade, B minus. So that's much less than BB plus, because you go BB plus, BB minus, B plus, B, and then B minus. So this is like just above C. Yeah, high yield bond. All right, and this bond is also callable, which means that if Tesla had extra cash or wanted to refinance its debt at a lower interest rate anytime after August 15th of 2020, the bond could be called at 103.98, which means for a $1,000 bond they would pay $1,039.80 to basically redeem or call that bond. All right, that's a risk. It's called a call risk. All right, but let's look at this as of August 20th. This same bond, okay, this same bond. All right, now the last trade price is $104. So this bond is actually trading at a premium. All right, what happened? Well, it turns out that Tesla's doing pretty good. All right, here back in March, when everything was going down, and basically the state of California shut down Tesla's production facilities, and everybody was worried about whether if the economy was even going to happen, if the economy was really going under. Corporate bonds went down, especially high yield bonds went down. So we saw that the price here, which was pretty high, went all the way down here, down to, looks like even under $80. But since then, as the economy's recovered and Tesla has done well, Tesla's come out with some news that has been pretty positive in terms of its sales. So there's more investors are thinking, hey, Tesla's actually going to repay these bonds that are due in 2025. So if we look at the ratings, Standard & Poor's ratings has stayed the same, but Moody's ratings has actually gone up a little bit. So issued a new rating on July 23rd of 2020. Standard & Poor's has not re-rated the bond since it was issued, but Moody's did, and a slightly increase in the rating. So that's their opinion. Their rating is their opinion on the financial strength of the issuer, the financial strength, the ability of Tesla to repay the bond. Now we want to talk about yield curves a little bit. All right. So typically a yield curve is upward sloping. That's called a normal yield curve. So if you were to go out and buy a 1-month bond issued by a government or a corporation, you're not going to get paid a lot of interest. If you go out and buy a 1-year bond, you're going to get paid more interest. And if you go out and buy a 30-year bond, you would expect to get paid more interest. Why? Well, you have greater default risk. The longer the period you hold that bond, the more likely it is to default. Right? And on top of that, you have more interest rate risk, because the longer the duration of the bond, then if interest rates go up, the value of your bond could fall fairly substantially. And the result of that is that long-term bonds typically will pay higher interest rates than short-term bonds. Yeah. So here is the what's called the nominal rate, and then if we were to subtract the rate of inflation from this bond, so here the rate of inflation, here's 1 to 3, was about 2.1% back on this date. the 12-month past rate of inflation, the increase in prices over a 1 year period of time of a basket of goods and services. What we see is that the real rate of this bond is less than 1%. And in fact, if you bought anything less than a 5-year bond, you were getting less than the rate of inflation. So this is a yield curve. It's simply a graph of the maturities of the bond and the yield that currently exists on that bonds. Now here is U.S. Treasury bonds, and in 2017, August, so this is 3 years from the date that I'm recording this. All right. Wow, here's the yield curve. And then what happened was, whoops, go back. About a year later, 2018, and we'll look at the red line here, it's the latest, interest rates went up. The economy was doing great, all right? People were saying, hey, the economy is doing good, and interest rates went up. People had a higher expectation that there might be inflation, for example, and Federal Reserve was not buying as many bonds in the marketplace. Stuff that you study in economics and capital markets about what affects interest rates. But interest rates had generally turned it up. But now, today, if you were to go out and buy, here's 1 year ago bond prices, and here is today's chart, the yield curve of bonds. If you were to go out and buy a 1 month bond, you get close to 0% on a U.S. Treasury bond. And you get out here to 2 years, you're still not getting much. You get out here to 5 years, you're maybe getting 0.3%. A 10-year bond, as of today, is about 0.55%, somewhere in that range. And a 30-year bond, you're barely getting over 1%. These are historically low interest rates, amazingly low. All right. Now, another thing that we can look at is something called the yield spread. What if we take the yield of 10-year bonds and subtract the yield of 2-year bonds, and then we look at that over a period of time? So we do that calculation for different points in times. And this is what we come up with. 10-year Treasury constant maturity bonds minus 10-year 2-year Treasury constant maturity bonds. So basically, we're looking at bonds of that maturity all the time, and replacing bonds as they get less maturity with the same maturity 10-year. So a bond that goes from 10 years to 9 years, 8 months, we're replacing that with a new 10-year bond. And we're charting this minus the 2-year. And why is this important? And the reason is, any time that the 2-year Treasury bond yield is higher than the 10-year Treasury bond yield, that usually indicates that a recession is going to happen sometime in the next couple years. And in fact, we can chart that. 2-year minus 10-year, all right? Here's 10-year minus 2 years. As long as that's positive, we're okay. But when it goes negative, the shaded area here is what happens in a recession. So here it went negative, went back positive, went negative again, had a recession. Did pretty good for a while, went negative. Within 18 months, we had a recession. Went negative here in 2000. We had a recession in 2001. Went negative here in 2006, 2007. We had a recession in between 2008, 2009. And it was still positive. Oh, was it? So here we're going to update this chart and look at what happened here in late 2019. All right. It actually went negative again. And we are now in a recession. We are in a recession currently. So as of the date I'm recording this, August of 2020. So kind of the question here, wow, the economy was doing really good then. Did the late 2017 interest rate inversion predict the pandemic that caused the recession? No, of course not. It's not 100% accurate, but it's very, very accurate. And it's like 9 of the last 9 times that the interest rate has inverted, where 2-year rates are higher than 10-year U.S. Treasury rates. A recession has occurred within the next couple years. Another concept that we need to know is the current yield of the bond. All right? It's basically just the annual interest rate divided by the bond price. And I'll just illustrate this. If the interest payment on an annual basis is $5, so uh, and if the current price of the bond is $9.55, what is the current yield of that bond? And what we find out is that the current yield is 5.236%. This bond is at a discount, so we get a bond that has a higher yield to it. All right. Then we have another concept called yield to maturity. When I go out and buy bonds, I'm looking at yield to maturity unless the bond is callable, and I try to avoid callable bonds for my clients where it's possible to do that. And there's a complex formula for that, but again, you can do an online calculator to complete yield to maturity. In fact, we're going to pull one up right now. I'm going to pull over here. If I can do this, here we go. Zen Money has a nice little calculator here. We'll blow this up again. All right, so we'll say the bond is just now been issued, and it's we'll say a 7% bond, and it has 10 years, well, we'll say 12 years to maturity. And we can submit that, and we can find out that the current yield is 7% and yield to maturity. But what if the price of the bond goes down? We can actually go into the marketplace and say, hey, this bond, we can buy that bond now for $920, or 92, it's quoted as 92.00. We can submit that again. We find that the current yield, remember that very simple calculation, is 7.69, and the yield to maturity, which is that more complex formula, is 8%, 8.065. So kind of a nice way of doing this. All right. If the bond price went up $1,120, and we're going to recompute this, we see that the current yield falls, and what's important to us is the yield to maturity, 5.6%. Yeah, because now interest rates have gone up, have gone down, the price of the bond has gone up. So a similar bond could be bought in the marketplace if it was issued for $1,000 at 5.6%. So again, just another calculator here, so we don't always have to use our financial calculator for that. We're actually going to do a little bit of that later in this course, but the simple way of doing it is to do an online calculator. So let's go on here. All right, this just illustrated that. Hypothetical yield curves. All right, so if you compare yield curves, short-term bonds have a lower interest rate than long-term bonds. If you were to buy a U.S. government or Treasury security, all right, typically those are going to have a lower interest rate than investment-grade corporate bonds, highly rated corporate bonds, and typically those are going to have a lower interest rate than high-yield bonds. All right. Now these yield curve don't always stay like this. All right. Well, one is yield curves can go like that. They can actually be inverted and all that. But the spreads can be different too. The spreads between a U.S. Treasury bond and an investment grade bond could be investment grade corporate bond could be much greater or even less. And the same here for high yield bonds. So what I'd like to do is give you a little tour of a broker-dealer's bond site. So let me pull this up, and you're going to have to bear with me because my clients I have my clients' accounts at TD Ameritrade, and they have a dual factor identification, and it doesn't last very long. If I were not to be active in this, it kicks me off, so I have to do this really fast. Of course, they change this number all the time, so that I'm not telling you anything here that's secret. All right. Now I'm in this bond site, and I'm going to, of course, make this a little bit bigger so we can all see it. Alright, this just says, hey, of my clients in terms of what they hold at TD Ameritrade, it's $26 million and the like. And I'm going to search for, I'm going to search for somebody who doesn't have a lot of money and who wouldn't mind. Michael Izelhard is my son-in-law, and going to pull up his account here. All right, and see that. And oops, I want to pull up his account. He's got, this is just one of the accounts that he has, 25,000 in it. And then I want to come over here to trading. So I'm going to assume he had some cash in his account, and I wanted to buy some fixed income investments with that. So I'm going to their fixed income desk here. Now, unfortunately, I'm doing this on a weekend, so they haven't loaded all of the prices of their bonds, but I can find prices of CDs on these bonds. So I'm going to go to 1 to 3 year CDs and say, hey, what can I buy out there? There's actually a 30-month CD, non-callable, issued by BMW Bank of North America. Corporations, some corporations actually have their own banks, and that's a way they raise money. The yield to maturity is only 0.25%, and I could buy that bond, all right? And if I wanted to just, this is all the bonds that are out there. If I wanted to buy, let's say, 5,000 of that, I would put in a quantity of 5 because they're issued in $1,000 increments. I would preview the order, all right, and this would come up and it would say I'm buying $5,000 a bond, 0.25%. I can't buy this for an Ohio resident because probably the bank is located, Ohio has some banking restriction on that. And I would enter the account name and the account number here, and then I just press enter and it would fill that. And I can do the same for corporate bonds. I can search for corporate bonds and the like as well. So I just wanted to show you, this is basically how you can buy bonds at a broker-dealer firm. And you can set up your own bank account and go out and buy banks. Now, different brokers have different approaches to that. TD Ameritrade operates as what's called an agency, so it doesn't actually own bonds itself. But if you were to go to Schwab or Fidelity, they actually have their own bond holdings, so they not only offer bonds that people are trying to sell represented by other broker dealers, but they also offer bonds out of their own inventory. And there's pluses and minuses of that. All right. So let's go on. Well, just a little bit of review. Exercise self-control. Exercise your self-control muscle. You're never going to be perfect. All right. Avoid procrastination, especially with your study. Make sure you have a time set aside on your calendar to do studying first before all the other stuff, and put yourself in a situation where you're not going to get interrupted a lot. To get started on projects, just say, just do it, do it, do it, do it, do it now. Say that out loud, and it really helps you get started. And of course, grit is very important. Perseverance over the long term. Your goal is to get a great job. That's what going to college is. A great job in a field that you want to work in. And to do that, to get a great job, you're going to need to do well. And of course, never, ever give up. And if you have any problems along the way, just reach out to the bear, and I'll be happy to meet with you, or have a phone call or a Zoom conference with you. So, again, another big thing you can do is set goals by semester. All right. Specific, measurable, attainable, realistic, and time-limited goals. You should probably set 3 or 4 every semester, and that's one of your expand your comfort zone activities as well, is establishing goals as well. So I am going to leave you with this. This is the introduction to this class preparation assignment. Again, try to wait a day before you do the readings and maybe some more videos in those readings. And then another day, if you can, to answer the questions. Space out your learning.